Welcome to the Opportunity Zones podcast. It's a live OZ Pitch Day panel discussion with three distinguished guests. I'm joined today by three members of OZ Insiders: Andrew Daup of Syndication Counsel, Jill Homan of Javelin 19 Investments, and Connie Rathbone of Weil Fotheringham Law Firm. Today's panel discussion, we're going to answer the question, why invest in opportunity zones now? Opportunity zones have been a little bit beat up the past couple of years, I feel. The equity raising is way down, but to start us off, I'm just going to ask a pretty simple question, high level question, I guess. Let's just keep it at that. Why should investors still invest in opportunity zones now? And I'm just going to go around the horn in the order that you're appearing on my screen. And you can also quickly introduce yourself as well, along with your question. We'll start with Jill Homan. You're on my screen first. So Jill, let's turn to you.
Great. So good to be with you, Jimmy, and thrilled to be on the panel with Connie and Andrew, leaders in the OZ space. So Jill Homan with Javelin 19. Also, I'm a partner with Pinnacle's Opportunity Zone Fund. So really great group of people. So to answer your question, why invest now? I think the Opportunity Zone tax incentive, if it expires, will be a once-in-a-lifetime tax incentive for investors who would like to make a long-term investment and have an opportunity to receive tax incentives that I think will be once in a lifetime. So that's why I think why invest now. That's my punchline. Is if Congress does nothing else, this will all expire. This will all go away. And I think you'll be having situations where folks will be, sitting around the table or out the golf club, and one person will be talking about how when they sell the asset, he's not paying or she's not paying any taxes on the sale. And then the other guy or girl will be saying, oh, I missed out on that. So again, I think this is a once in a lifetime opportunity, which is why I'm so bullish on this.
Yeah, good point. It's a perishable tax incentive, and it is expiring, unfortunately, sooner than we'd like it to, unless we do get that extension possibly next year. Andrew Daup, you are next on my screen here. What do you say? Why invest in opportunity zones now?
Yeah, thanks for having me on, Jimmy. Happy to join the panel with Jill and Connie. I run a law firm out of my office in Columbus, Ohio. We focus exclusively on QOF and QOZB syndications. So working with developers and project sponsors on organizing their business plan into a company, and then advising them on how to capitalize their company in partnership with private investors looking for yield. I agree with everything that Jill said. And I'd also echo the statements that you made to open up the event today, Jimmy. Could be one of the greatest income tax incentives in U.S. history, and it's scheduled to expire, which I think is, one of the part of the brilliance behind the legislation at the outset. It's not going to be around forever. To add to what Jill said, it's funny looking back. I think you and I crossed paths at what might have been the first National Opportunity Zones conference out in LA.
Yeah,
that was probably 2020, January timeframe.
That was January of 2020. Yeah, downtown Los Angeles. I remember it well. That was a good one.
Yeah, I don't know. So I remember, there being hundreds of people, packed into these conference rooms. Everyone was trying to figure out what this legislation was and how it could be used. And back then, we really didn't have a lot of answers. I'm an attorney, and all we had was, the statute, which we could use to provide guidance to our clients based on our interpretation. But we didn't have any regulations to guide that advice. We have that now. And we have a marketplace that has experienced, 5 years of maturity since then. So a lot of the risk of uncertainty that, used to give investors and their advisors pause, that no longer, is really as big of a concern as, just, routine deal risk, irrespective of whether it's an OZ or non-OZ project. So, long way of saying a lot of the regulatory uncertainty associated with this program, I think, has been put to bed. Now is a great time, perhaps better than ever.
Good points there, Andrew. Just one minor correction. That was actually January 2019, a little longer ago than we thought. that first OZ conference out in Los Angeles. Connie, let's turn to you. We haven't heard from you yet. Quick introduction and why should we invest in opportunity zones now?
Hi, thanks. And you can just say VF Law Firm because the name is so crazy. And I have basically the same background as Liam. I do all things real estate and securities and most things business, but in the real estate industry. And the question why invest in opportunity zones now is because, as everyone said, it's expiring. And whether or not I think that it is fairly clear that most people in the Senate and the House think the Opportunity Zone program is worth renewing, but the crystal ball is whether there can be an overall tax package that can pass, because we can't extend Opportunity Zones without a tax package passing. And one of the areas that I would like to focus on that's a little bit unusual is to direct people in the area of rural. And I'm not sure you're ready to go there yet, Jimmy, but that's an area that I've been focusing on and is pretty enticing, given the incentives that you can attract when you're in a rural area.
Well, I made a note to come back to that in a minute here, Connie. One thing I hear about opportunity zones, and actually one huge misconception I hear about opportunity zones when I'm talking to people who are just learning about it, or maybe they've heard about it, but they're not too familiar with it. Sometimes I hear, wait, didn't that go away already? Haven't the benefits already expired? Is the deferral period still around? And some of it has expired, to be fair. One very minor benefit of the program, the basis step up on the original gain, has since expired for new investors. And the deferral period, granted, is shorter now than it was if you had invested in 2019 or 2020. But I like to point to there's an ancient Chinese proverb, the best time to plant a tree was 20 years ago, but the second best time is now. I think the same could be said about opportunity zones. Probably the best time to invest in opportunity zones would have been in 2019, 2020, really take advantage of a really long deferral period and get that basis step up. But the second best time is now. I'll tell you what the worst time to invest in opportunity zones will be after it expires, kind of to echo our other panelists' thoughts. So let's talk about that right now. I mentioned opportunity zones have been a little bit beat up, it seems, the past couple of years. According to Novogradic's survey, fundraising in 2023 was down 64% from where it was in 2022. Why are fewer people investing in opportunity zones now? Are they missing out? Or any other thoughts that you want to share? Let's start back with Connie again. We'll snake back our way around. So you can get first crack this time, Connie.
Yeah, I think that the interest rates have a huge impact on every real estate investment, and in particular, well, not in particular, but real estate investment. So I think that the returns are not as attractive because of the interest rates. I think that with respect to the timing, Jimmy, I think I'm going to be doing a whole lot of husband and wife opportunity funds on December 30th, 2026, because when I teach about opportunity zones, I talk about the wow factor, and that's the last benefit, which is no tax on the appreciation during the hold period. So even though you can't defer on your capital gains going in, people will still be able to obtain the wow factor, which has always been the most attractive benefit in the program.
Yeah, good point there. Andrew, any thoughts from you?
Yeah, I would say the worst time to invest into an opportunity fund is after your 180-day deferral period. Because I mean, yeah, that situation happens, and there's a lot of flexibility with what you can do in the land of OZ, so long as you satisfy that 180-day deferral period requirement. So that's an important deadline to pay attention to. I agree with Connie. My expectation is that investors who have heard about opportunity zones, they're aware of some of the benefits sunsetting, but the response is investors are still in for the benefit that everyone is mostly excited about, and that's this prospect of a tax-free exit after the 10th anniversary of deferral. So yeah, my expectation is that investors will rush to seed, to form their own self-directed QOFs and seed them with whatever capital assets they happen to hold and can sell in short order, so that they can lock in the primary benefit, that 10-year tax-free exit, and then hold it. Why sell it after that 10th anniversary? Hold it for as long as you can, maybe up until 2047.
Yeah, that's another thing I hear oftentimes that I like to kind of steer people in a different direction on is, wait a second, 10-year hold, that's a long time. How fast can I get out of this thing? And I tell them, no. You're thinking about this wrong. This is like a mega Roth IRA. You don't want to be asking how quickly can I get out? You want to be asking how long can I hold this opportunity zone investment and let it eat and grow tax-free. Jill, any thoughts on, why is OZ investing down the last couple of years? Investment volumes down. By the way, it's not just restricted to OZs, this downturn in investment volume. This is actually across all alternative asset classes and real estate sectors over the past couple of years. But any thoughts there, and any other thoughts you wish to share on opportunities on investing?
Yeah, so it's really two reasons. Number one, Connie touched on it, which is the profile of deals, trying to make the deals work when you're in an inflationary environment, high interest rate environments. And so deals that have been ready to go, a lot of those deals were underwritten with 4% interest rates, underwritten with anticipation of getting a certain hard cost budget. And then that deal now, when it's being capitalized, the hard cost number is higher. The construction loan interest is blown out. The refinance assumptions are not realistic. And so when it's all re-underwritten, the return on cost is and then also the investors' expectations on returns have gone up. And so it's like you've squeezed the deal, and then you say, oh, and by the way, we need a higher return because everybody's cost of capital is higher. So whereas deals that were in the low fives return on cost, that investor now wants something, a higher return. And for a developer, for a lot of projects, there's just no levers to pull. So it's really hard to find deals that work. It has been hard to find deals that work. So that's one piece of it. The other piece is opportunity zones. The way it works is it starts with a capital gain. And so if you're looking at the equities market and you're seeing, volatility, you're concerned about the long-term hold of your portfolio, what it looks like, people aren't harvesting capital gains. And so what I'd suggest is that people's interest in investing in OZs tracks well with the stock market. So when stock markets are getting to an all-time high, when your Apple stock now again once jumped over in Nvidia, you're thinking, you know what, maybe I can't make sense of this market. Maybe it makes sense for me to sell out of my Apple stock right now and take my capital gain. And so we're now in an environment where we're seeing a lot of activity. I mentioned we're a partner and I'm a partner in Pinnacle Fund. It's a fund of 5 deals, multifamily in Denver, Nashville, Phoenix, Austin, and Charlotte. And interestingly, the fund is closing at the end of the month. And interestingly, the level of activity that we're seeing from investors, we have a call to close. Given where the stock market is, people have NVIDIA positions, NVIDIA split. It's just makes a lot of sense for someone who now is overweighted in equities to say, you know what, maybe I need to push more of my portfolio over to alternatives. And so to close the thought, it's, you think of it as the investor has a capital gain, and the reason people have been investing less up to this point is it tracks closely with the market and people's perceptions of wealth and whether they want to harvest gains. And then secondly, the ability for people to find good investment opportunities. And that's been a challenge of late. But I'm optimistic. I think the market is loosening up in terms of investor appetite. I think that's coming, that's been very strong, really recently. And I'm also optimistic. I think as the last panelist mentioned, I think folks here can attest to, I'm optimistic that, for markets that may have been overbuilt a bit, the construction starts have fallen off a cliff. And I think if you give markets, which are super high growth market, you take Denver alone, there's 70,000 units under that need housed there, I guess undersupplied is the correct term. And so these markets need supply, but it's not, always where you want the supply to be. But the point is construction starts have fallen off a cliff. And now I think I'm optimistic that you get some of these projects going maybe 6 months from now or a year from now, that it will help smooth the market out and be a good investment opportunity for folks.
Well, you're talking about the stock market. It's a perfect segue into a point I was about to make, which is if you look at the stock market, the Dow Jones Industrial Average hit 40,000 for the first time a few weeks ago. The S&P 500 is just off of its recent highs, but it's up about 88% over the past 5 years. If you're a stock market investor, I'm sure the vast majority of people listening to us right now have some exposure to the stock market, either through individually held stocks, maybe Apple, maybe Nvidia, to your point, Jill, maybe through ETFs or mutual funds, certainly. If you're a stock market investor and you haven't rebalanced your portfolio in a year or two, you probably have some pretty sizable unrealized gains there, and maybe it's time to rebalance. You might be a little bit overweighted towards stocks. You're 1 or 2 years older, and your stock market exposure has increased. You're probably going in the wrong direction there. We oftentimes talk about year-end tax loss harvesting, but Jill, I love that concept of tax gain harvesting, specifically for the purpose of, well, twofold. One, get your stock weighting back in line with your target asset allocation, and two, take that gain and reallocate it into this tax mitigating investment opportunity zones. So any comments on that point from Andrew or Connie? And then one more question that I'd like everyone to address is, we're talking about opportunity zones and the fact that it's a great tax mitigating investment program. I declared it earlier the best tax incentive program ever created, tax investing incentive program ever created. But how do OZs compare to other tax mitigating investment programs, and any pros and cons, any similarities you can draw with those? So a lot I threw at you there, a lot to chew on for our panelists. But Andrew, you haven't gotten to go first yet. I'll start with you. Any comments or follow up there from you?
Yeah. All valid and great points. A lot of the clients that I work with, they are, they're taxpayers who had a cap gain event. So they're coming to me after they've realized or recognized their gain. And for them, it's a really easy decision. It's, do I want to pay my tax to Uncle Sam, or do I want to instead pay it later by investing it into either my next venture or into a private venture that's professionally managed by someone else, so that I can sip margaritas on the beach. So from that perspective, 9 out of 10 times, or maybe even higher, the answer is going to be, I'd rather pay it, later than sooner. And then after that decision's been made, the next discussion is, well, what's your preference between an actively managed OZ business or a passive investment into a professionally managed OZ fund or OZ business? As far as comparisons to, other income tax incentive programs in the tax code, the general point of entry for discussion to new taxpayers considering opportunity zones is just comparing and contrasting to DSTs and 1031 exchanges. And, Jimmy, that must be your experience as well, because you had an excellent slide that you put up to open up your keynote today. And, it lays out, really clearly, why you might be inclined to opt for one and not the other. Ultimately, it's going to be dependent on, the individual investor's objectives. But again, from my perspective, I love the flexibility that you can get with opportunity zones, and most of my clients do as well.
Yeah, there's also QSBS is another program that it gets compared to, sometimes a little bit less frequently. And then an offshoot of 1031 exchanges is Delaware Statutory Trust, or DST investing. Connie, let's hear your response to what we've been talking about here. Chance for investors who are stock market investors to roll over into a tax mitigating investment program like Opportunity Zones? And how does Opportunity Zones compare to different tax mitigating programs like 1031s, like DSTs, like QSBS, and maybe some others that I'm not thinking of?
Right. Well, and the one that you left out was tenant in common.
Yeah, there you go.
You know, that industry crashed, and I ended up representing about 150 groups. The opportunity zone investment in general is quite a bit more flexible than 1031s. One thing that I have advised my clients for my 36 years of practice is don't invest in a 1031 exchange that you would not invest in with clean money, because it's about the property, and that's what people lose sight of. I will advise them the same thing with opportunity zones. Is the issue is the property. And so for 35 or 36 years, my clients have ignored me on that advice and gotten themselves in trouble. But, you know, one of the big things, the big bonuses with an opportunity zone versus a 1031 is that you don't have to reinvest the debt, right? And so that's a big element of it. Delaware Statutory Trust, and I think it's similar to opportunity zones, you are giving up total control of the property. And so if you have investigated the sponsors as well as the property, then those can be very similar. But unlike a DST, an opportunity zone can be refinanced, and the owners can benefit from the refinancing to pay the taxes when those come due or at other times. And so I'm not familiar with the other one that you talked about. I've worked mostly with tenant in common, DSTs, opportunity zones, 1031 exchanges. And, you know, you can get some additional depreciation benefits and opportunity zones over 1031 exchanges. And for a lot of people, it's nice to be able to stop the roll of the 1031s that they've been in for the last 25 years, and maybe finally get out. Even though they have to pay their taxes on the gain that they invested, they might be able to get out that roll and take advantage of the 100% step up in basis without dying first and passing that benefit on to their kids.
Yeah, so the other one we were discussing was QSBS Section 1202, I believe it is, qualified small business stock. Some similar benefits to opportunity zones, but only requires a 5-year holding period. There's different hoops to jump through, different hurdles you have to clear. Jill, any response to what we've been talking about the last few minutes here, and how OZs compare to other tax mitigating investment programs?
Yeah, I thought it was very well covered. I just want to underline Connie's last point that she made. When I talk about, an investor making a decision to invest in a 1031 versus opportunity zones, what I say with OZs is you can actually exit the investment without dying, and you get the tax benefits. With 1031, pay the tax or you have to die. So, with OZs, you can stick it to the man, you can get out without paying your taxes, and it's all tax depreciation plus no depreciation recapture. But and then just so I thought that was very well covered. So yeah, and with QSBS, I've seen generally that be used more for operating businesses in terms of structuring.
Right. We had a question about QSBS. I want to get to that in a minute, but wanted to make sure we covered this next topic first. We do have about 10-ish minutes left in this panel discussion today. I want to get to a few questions. It looks like we got 3 or 4 questions queued up, but did want to touch on how you or your clients are investing in opportunity zones this year in 2024. If you have any examples of maybe specific deals or just high-level concepts. And Connie, I'd love for you to talk about rural at this point as well. And Connie, we'll start with you, actually. Let's get to your rural talking points.
Great. Well, it's my experience. I practice primarily in Idaho and Oregon, and really kind of all over the U.S. because I'm only a transactional lawyer. But what I have found are that rural areas are just very, very favorable towards assisting developers if they'll bring a development to the area. I'm working on a 1,200-acre parcel to build a city within a city. And, this concept that we have used, which is stacking incentives on top of the opportunity zone incentives, has been really beneficial. We have $6 million in grant funding that's been committed to build the infrastructure, and it will complete all of the infrastructure for our first phase of 160 homes. This is in a small town in Eastern Oregon. Each home receives a 7% cash rebate upon completion. All SDCs are fully paid by a local urban renewal agency that we helped get created. And the net result of these three incentives is an average profit increase of $30,000 per unit. And so every state and every county has a different basket of incentives that you can target. But and I'm also going to talk to not Liam, but the presenter before that about this element of eliminating property tax.
That was Barrett Lindbergh in Texas.
Barrett, yeah. Maybe we better be talking to Harney County about this great program that Texas has if they want affordable housing.
Yeah.
And so people are fleeing the metropolitan areas and the increased crime, et cetera, and working remotely and wanting to go to rural areas. And I know from experience that it's been hard to persuade sponsors to go there and hard to persuade, sometimes bankers to go there. Luckily, I work with the owner of all 1,200 acres. And so we've been able to go forward with that. And this community had been receiving one business request a week for the ability to move to their community, but there was no housing and nothing to do. So we're solving for those. And it's kind of an unusual expertise. We've helped some businesses on the Oregon coast, little coastal towns, et cetera. But it's not just the big cities that benefit by these.
Good explanation there, Connie. And I'm looking forward to hearing more about that deal, and hopefully we can get you to present it at an upcoming OZ Pitch Day, maybe in November or certainly in 2025.
Yeah, we're working on that.
We're ready to go. Good.
High on the list.
Excellent. And Andrew, let's turn to you now. We haven't heard from you in a while. Sorry.
No, good.
How are you and your clients investing in OZs? Any particular deals or concepts, strategies that you're thinking about for your clients?
Yeah. So my practice is it's not limited to just real estate projects. So circling back to the QSBS commentary, you can couple two incentives, the QSBS and QOZB, into the same capital structure. And I advise clients who can qualify for that exemption on how to do that. What I see is the primary reason why it's not being done very widely is just because if you're coupling the two, then you're narrowing your investor class to a very specific type of investor. Because VCs aren't really accustomed to limiting the type of cash that they can put into a startup with pre-tax cash. It's a new concept to them. And a lot of them aren't even paying cap gain to begin with because of this QSBS exemption. So the educational curve can be higher. In a lot of cases, even if after you cross that threshold, it's like, well, why limit ourselves any more than what's worked with us in the past, which is relying on the QSBS exemption.
So it's not redundant to stack QSBS and QOF incentives then. That's what was one of the questions.
No, it's not redundant. It's just, an extra, hurdle, extra compliance hurdle that the QSBS or the QSB operator would need to satisfy in order to ensure that it receives tax treatment as a qualified small business. Similar to the hurdles you would need to satisfy as a QS or alphabet soup, QOZB operator.
To be clear, the reason you do that is so that you create optionality between your hold period year 5 and year 10, right?
That's right. Yep, that's right. I would love to see more I would love to see more incubators in opportunity zones. I do think that is, it's just an idea that hasn't really been well developed or developed enough. But it'd be awesome to see OZ incubators.
I thought we were going to
startups.
see. I thought we were going to see more of those. And I talked with some groups early on in 2018 and 2019 and 2020. You buy a plot of dirt, you put a co-working space in it, and then you also own pieces of all of the QOZBs that are being incubated inside that building. I thought that's a brilliant concept, but I haven't really seen it done at scale very successfully. I don't know, Jill, any thoughts on how are your clients investing in opportunity zones currently? Any specific strategies or particular deals?
Yeah, I mentioned the multifamily fund, the residential fund, and then what we're working on now with Pinnacle and Trilogy Residences. They're a build to rent developer, very large, and so it's a co-GP build to rent opportunity zone fund. And so build to rent has really become a very, very attractive asset class for investors. And I think a lot of it has to do with, you look at, again, the interest rate environment. So for an individual would be buyers by necessity. Renters by necessity. So you look at the interest rate environment, it's 7%. It's hard to get all the money that they need to buy a house. In a lot of these houses were built under earlier times, and so the housing affordability in a lot of markets is just very, very challenging. And so you have an increasing number of people who need to rent, and then you also have an increasing number of people who want to rent because they see the 7%, and they and they also don't want to be permanent in a location. I think a lot of people during the pandemic realize that they want some flexibility. And so there's a significantly growing number of people who want to be renters. And so these are purpose-built homes, either single-family homes or built-to-rent homes, built-to-rent community townhomes, and that are rental. And so that's been a very, very attractive asset class. It's become institutional. And so there's a fund that we're working on with 3 projects in the Southeast, in Atlanta, Decatur area, Augusta, and Huntsville. So that's one of the strategies that we're working on. And so I'd say we're keenly focused, my lens is keenly focused on real estate, primarily been working with investors who really like multifamily or like residential, like build to rent. And some of that has to do with the liquidity at refinance. And so as, over the last 2 years, particularly, post-COVID and when the market started to slow down, it became very difficult to refinance. Again, needing to refinance, meet a debt service coverage ratio at higher interest rates means the loan proceeds were down, but people levered at, 65 or 70%. And so for a lot of folks, it was hard to refinance out. And so on the residential side, having the agencies and also pension funds and others want to finance more, to provide more loans, that's provided more liquidity on the capital market side. And so that makes it, as you kind of rewind that, it makes it an attractive asset class for investors. So that's kind of my lane. But kind of circling back to your comment, Jimmy, about incubators, and I thought that might have as well been a strategy that folks would pursue. But I think some of the challenges, I think with the opportunity zone compliance, and I'm sure Andrew and Connie can speak to that, with what I described it as on the real estate side, if there's, say, 10 requirements to comply with OZs, the real estate maybe starts off at, with 6 of those in, easy, because we don't move, we can't move. The business is right there, the employees aren't moving. And so it's just, there's a thicket of requirements that on the operating business side that they need to do, I think, which makes it more difficult, more costly. So I think that might be some of the challenges. But my hope is if we get an extension, as Connie alluded to, that some of these might be a little bit easier to deal with.
Well, hopefully so. Fingers crossed there. We're a couple minutes over time, but I did want to get to one or two more questions. I'm the next presenter, so reading into my time now. That's fine. Should we consider yeah, so here's some live questions from the audience. One question is, should we consider diversifying by investing in multiple opportunity zones? The storage guy, he refers to Russ Colvin as the storage guy. I couldn't remember the name, but yeah, it's Russ Colvin with Your Space America. He had a $25,000 minimum, and it got me thinking. And I'll quickly answer. I would say if you're a stock market investor, you probably don't have all of your money in NVIDIA, although, boy, it would be nice to have done that a few years ago, right? But usually you want to have a diversified portfolio. So me personally, I am invested in multiple different qualified opportunity funds across a variety of different asset classes. So I always think it's smart. You don't have, if you have one big capital gain event, you don't have to pour that entire gain into one QOF. You can split it up into multiple. I don't know if anybody else had any additional thoughts there.
Yeah, or you can form your own QOF and diversify across a portfolio of QOZBs, and be in a 10-year partnership with your spouse or another family member, and not have to worry about what an operator is doing when it comes time to exit.
We had a question here from John Burlett for Jill, real quick. I think you can answer. He wants to know, Jill, does Trilogy do business in Texas for build to rent?
Yes.
Yes. Good answer there. And then we'll wrap up with this final question here. And then I'm sorry, I got to cut you loose to move on with the program. But what return do you look for given local market conditions, i.e. plus or minus X% versus non-OZ? What kind of returns do you like to see in a QOF or deal level? I don't know. You can say fund level or deal level. Specify the type of return you want to see. Shout it out.
From 8 to 15.
8 to 15 from Connie. Jill, how about you?
Just in the simplest form, let's talk about return on cost.
Sure.
An untrended return on cost, that's about 150 to 200 basis point spread over current cap rates. And, that becomes a challenge if there's not a lot of trades. And then you have IRRs that are really driven, that's at, maybe about 15, but those IRRs can be financially engineered, and that's why we always start with a untrended return on cost.
All right, and Andrew, I'm going to give you the final word here, and then we're going to wind down.
Yeah, mine's unfortunately going to be a little more nuanced because I have this conversation with clients a lot. It's, well, if I'm organizing a QOZB or a QF, what should I offer, to investors? And my answer is always the same. It's every investor is going to have different investment objectives. So you need to figure out what your business plan is and be consistent with your narrative. And I'll just give you an example. If you're a single asset real estate project, you need to be competitive with other single asset projects in your asset class. So, 8 to 12% probably going to hit the market that you're looking at. But I've also seen multi-asset, minimum 10-year partnerships that are, compounding exits, and delivering, crazy multiples over a 10-year time horizon. And they're positioning themselves as not a cash distribution machine, but instead more like a 10-year self-directed IRA, where the pitch is don't anticipate any cash flow during that time. Instead, we're going to reinvest that cash over that 10-year period and maximize the value of your tax-free exit. So depending on what kind of investor you're speaking to, you might imagine how one could resonate more with the other.
Awesome.
That's completely true.
Excellent. Well, thank you, all three of my panelists today, all OZ Insiders members. Thanks for your insights. Andrew Daup, Jill Homan, Connie Rathbone. Thank you so much.
Thank you, Jimmy.
Thanks, Jimmy.